Well, welcome once again. This is Kenn Renner, real estate expert in the Austin, Texas area. And I'm so glad you're taking the time, taking your lunch hour if you're in the Pacific area to join me for this webinar. We have a lot of great information that we're going to be presenting regarding the Austin, Texas market. And also, we're going to be talking about, in general, some really great strategies in regards to taxes, self-directed IRAs, and all kinds of different tools that we can use to be able to leverage our market that we have, having such a great real estate market here in the Austin area. You know, we've had really ever since the 2007-2008 crash, we've had you know, in other parts of the country. Fortunately, Austin really kind of just leveled out. We didn't take the big hit like a lot of the areas. I got some charts that are going to show that. And then, you know, we've really seen now that there's so many people moving here because of the great jobs that are available and really the lifestyle. And so let's get started here, and we'll go ahead and this was basically a two-part seminar or webinar that I did. I did the previous one last month, and I have that on YouTube, and you're welcome to go and visit that and review what was on there. And these are the same slides, but I'm just going to blow through the slides that we saw last time to get to the stuff that I promised I would talk to you, which is more down the line of financing, tax advantages, all that fun stuff. All right, so let's get into it. Just a little bit quick about me. I've been 30 years in real estate. I'm an investor myself. I buy the product that I sell. I know Austin. I've been here since 1993, 20 years in this market, and one of the top brokers in the area with over 100 million in sales here in the last 6 years. Over a $250 million since I started in 1983, and a lot of that's been for investments side of things. I'm an author. I get around and do a lot of national speaking. Been on national TV with House Hunters several times, 3 different episodes that were aired more than 3 dozen times, so it was kind of fun. Now, if you want to watch part 1 of this webinar that I'm talking about, which contains the slides that I'm going to blow over here because it's already recorded, just search in YouTube for Austin Investment Webinar, and I'm the first video that comes up, and you can really get into and see the stuff that we covered last time. Couple things. If you go to Amazon.com and type my name in, Kenn Renner, you'll find a couple of my books, several of my books, and I've got another one coming out, believe it or not, the next, it should be out by Christmas. We've gotten through the editing part. We're just now gathering our testimonials and endorsements. I'm excited about that. It's called Maximum Dream Achievement, coming up here soon. And the Video Quick Start Guide, I'm doing a series of Video Quick Start Guides for a number of people, a number of businesses, which would include right now real estate. Of course, that's my business, and also going to be talking about using video in small businesses and using video for speakers and information marketers and professionals and things like that. But I'm kind of the recognized expert on the YouTube stuff and have over 10 million views on my YouTube channel. There's a chat box that you can use if you want to ask me a question as we're riding along here. You can, I won't necessarily always answer it right away, but ask your question and we can put it in the chat box, and I'll be able to answer it sometime along before the end of the webinar. Some really exciting things coming up. Oh, here we are, Wednesday, September 26th is our 12 noon, 2 p.m. Central Time webinar we're on right now. I do have a seminar that I'm, two-night seminars that I'm putting on in October 24th and 25th at the Hyatt Regency in Irvine, and I'll be talking on the first night about general real estate investing. Second night, I'll be talking about Austin, Texas. I'll also be introducing my Real Estate Investor Club, and that's going to be a mentoring and networking for serious investors. I'm going to cover a lot of the kind of stuff that we cover in this kind of webinar and even deeper, but also network with other people, which is great. It's what it's all about. It's a community. Okay. So keep in mind, I'm gonna stop and start going through this webinar because I did cover a lot of this last time. So if you miss it, just go back to the last recording, and like I said, we'll be able to cover it. This was Austin in 2004, and this is Austin in 2013, 2012, this year. Quite a bit different scenes taken from the same building, and really, real estate in general is on the comeback. And once again, I'm not going to read these slides because I did it last time. But the bottom line is that really real estate is no better time in history to buy real estate, with the lowest interest rates in history, the lowest prices on the comeback, and the highest rents we've seen in history, at least here in the Austin area. And all that equals cash flow. And that's what people are buying for, is cash flow. And it works really well with self-directed IRA strategies, retirement strategies, and we're going to get into that in a minute, I promise you. I do want to hang here just quickly. We read this last time, but even Warren Buffett said that single-family homes are a very attractive investment right now. And for him to say that means a lot to me. It just means a stock market guy that said he wished he could buy a couple 100,000 homes right now if he could figure out a way to do it. What I teach is just buy 10 homes over 10 years and pay them off in 20, and you've got a great retirement. Okay, so back again to the stock market. Daniel just pulled up this slide for today, and it's a wild roller coaster. And though it's up 10% year to date, I'm just concerned that it can drop so quick. Real estate's not like that. I'm going to show you the charts that prove that here for the Austin area. So this is the last 5 days, up 10% year to date. But when you look at 5 years, 5 year history of the stock market, really pretty much ended up, it's actually down. If you look down here below 5 year change, minus 4.82%. So real estate maybe in other parts of the nation had a chart that looks pretty much like this, but not in Austin. So bottom line is that it was one of the few investments that somebody else pays for your mortgage, and eventually it'll be free and clear. And talk about these trends that we've got. There's so many people moving here to Austin, taking advantage of the jobs, so many new license plates, it's great. And so many cool things coming up. The F1 auto race, the Formula One auto race that's coming up next month. Apple Computers moving here. Just really some exciting things that's coming up here for our Austin area. This is the chart that's made me a lot of money. And the reason is because I show people how Texas and California are on counter cycles. On the last webinar, I spent a lot of time in detail on this chart, so I don't want to take your time on this one. But the bottom line is that Texas is on a counter cycle with California. We are now on the up cycle. I don't know. I think California is still relatively flat, but I'm glad that I'm hearing from my friends in California that the market is actually, especially in the lower end, is starting to recover, and that they're seeing even multiple offer situations in California. The thing about it is that you're seeing multiple offer situations where it gets really frustrating to be an investor when you're trying to buy a property and it's not going to cash flow like it will here because the prices are too high compared to the rents. Here you can still, we had a pretty hot summer as far as sales were concerned, but here you can still get out and make an offer, or make an offer on a foreclosure and not feel like you're investing against 24 and other investors and never getting a property, because I know it can be frustrating to get in real estate investing and all of a sudden start making offers left and right, looking at property, it's taking your time and effort, and then find out that you got bid out by somebody else, or a cash offer or whatever it may be, and it just could be frustrating. Here you have a little bit more balanced market as far as being able to make your offers, get them in, and get them accepted. Really, Austin real estate, all I have to do is just refer back to Forbes's headline that they had a couple months ago, which just says Austin's the #1 boom town in the nation. So look it up for yourself, Forbes, Austin #1 boom town in the nation. You'll see that article. People are moving here. Got a lot of things going on. I'm not going to read these because I did last time, and so, but just just read it really quickly. All these great things that are involved with what Austin has to offer. We're huge employers, huge government. Home of Dell and Samsung has a $4 billion facility here. I mean, we've got a lot. We're also home to Whole Foods, which is obviously a poster child for this time and day and age. This is a description of what happened that made that chart that I just recently showed you. But in the last few years, this is kind of the history of the last 10 years, 04 to 07. Obviously had an investor rush, and fortunately the investor rush hit here, but it didn't get overheated like it did in Phoenix and Florida. So we didn't have the adjustment down like we did in those states. Now, right now, investors have sold a lot of their properties, and there's not a ton of new investors replacing those properties. So we have a very low supply of homes. 97% occupancy right now, and the first-time home buyers are snapping up whatever the investors don't snap up. So that's going to drive prices up. Period. So we got a lot of people are forced to rent. You know, I just talked to the builders around town, and actually I went to a closing yesterday for a client of mine that was in a move-up situation, and he said in his neighborhood, as he's just closing on his newly constructed home, that there's been slabs sitting there for the last month and a half with no building going on it because they can't get framers. There's not enough framers to build the houses, and so that's going to put a squeeze on supply, as it always has in the past. And and we also have a lack of developed lots, which is going to really, like I said, put a squeeze on the inventory. People are going to turn to resales, and they're going to end up buying up and driving up prices. Once again, we're not looking at buying properties right now so much for price appreciation. That's fine and good. That's what the people back in 04 to 07 were buying for. I'm trying to tell people that it's cash flow, because cash flow is king. This chart is worth coming back to visit if you do it on my YouTube channel. We've seen 20% increases in the last 5 years in rent. Some of these 20% increases were in the last year. So there's just nothing but proof that our rents are going up for the same reasons. All has to do with supply and demand and the jobs coming here. You know, another great look at the fact that we're kind of here, and we're just really lucky to be in Austin for the job growth and what it offers us. Once again, a chart showing our job growth highest in the nation. Population is going to double in the next 15 years. They got to live somewhere, and the chart has nothing to do but show you that people are going to continue to move here. And this is from the U.S. Census Bureau. Excellent chart to look at. Along with this chart for Austin, which shows the population here increasing. They're going to have to live somewhere. They're going to rent usually when they first come in, and sometimes they'll rent for a long time because they may be forced to rent because they don't have credit quite good enough to get a loan right now. The Gen Yers, the largest Generation Y, the 16 to 34s, are the largest segment of our population right now, and they are renting. That's what their normal mode is. They're not really necessarily always in the mode to buy, so they're going. Our biggest population center, the biggest population demographic, is going to rent, and that is perfect for a landlord's market like we have now. It means we're going to be able to charge more for rent. And here's a proof. Nationwide, home ownership rate's going to go probably back down to 64 to 63%, where it should have been. We actually had way too much growth in the home ownership rate than we should have. And so what's going to happen is, obviously, when we get back down to 63, 62%, like the economists predict, then the other 40 or 38% are going to have to do what? They're going to have to rent. Great time to be a landlord. Okay, kind of an interesting chart down the left. If you show, the constant increase over time of Austin, you never see really any big drops. We're actually hitting the highest median prices we've ever hit, which is still not that high compared to the rest of the nation. It's about right about 200,000 right now. And so what we have is, if you bought a house for 100,000, according to this chart, in 1995, it would be worth about 190,000. And in January of 2012. And this is what that leads us to, number one, a retirement strategy program, and number two is a college education strategy. And these are things that I'll be talking about in my Irvine seminar, where we're teaching people that, okay, you can buy one property and pay it off in 15 or 20 years, and that would be a nice addition to your income for your retirement. Or you could, over the years, buy 10 properties and pay them off by the time you're retired, and you would have basically be financially set. Same thing is, we encourage our home investors to, when they have their first child, is to buy an investment property that they can use for college education. In other words, they buy investment property when child one is born, and then they put it on a 15-year note, which right now would probably be about a break even on the mortgage without all expenses because of our rents are so high. Put on a 15-year mortgage, and by the end of when the kid's ready to go to college, you now have a free and clear house that, number one, they could live in for college housing if they wanted to go. If you bought it around here, go to UT, University of Texas, or you could just sell it at that time, pay the taxes on it, and then and put your kids through college. Now, keep in mind, the tenant was the one that paid off that mortgage over time. It's a great way. We're seeing a lot of people get involved with doing that, college education, college retirement funds. It's a chart from the Real Estate Center at Texas A&M University. We are at the highest median income that we've had in Austin ever. And you can't say that about other areas of the nation. But look, it's always continued to increase, except for a few years, in 2004, 2005, we actually dropped a little bit. But this is the continuing trend. We still have upward growth, upward movement to go, too, because we're still below a lot of the areas of the nation. Another chart just showing how our market's been performing. And you can revisit that on our last webinar. We have low months of inventory, and like I said, the builders are complaining they can't build them fast enough because they don't have the people to build them. They don't have the workers. So if you own a framing company or a construction company, Austin's looking forward for you to come on out here and get going, because we need your help. Once again, that counter cycle, that's just so kind of plainly shows you that right now may be tough times in other parts of the nation, but we're doing pretty darn good here. All right, so I kind of blew through what took me an hour to get through last time pretty quick, and I hope you appreciate that. And just want to give you some scenic tour here quickly of the Austin area. That's a picture from the Hyatt Regency downtown. Great place to stay. And the tallest building there is called the Austonian. It's a condo complex. So if you want to come out here and buy yourself a real nice condo and do a vacation rental by owner or whatever you want. The largest building in Austin. So, capital of Texas, built 4 feet taller than the United States Capitol. They always say everything's built bigger in Texas. Our high tech, Dell computers, and along with all the other high tech that we have, IBM and Samsung. We have these great toll roads now, that $3 billion worth of toll roads. Do you know that they've raised the speed limit on the toll roads to 85 miles an hour? Now, I know those that are in Orange County are used to going 85 or 90 on the 405 freeway when you can, but you know what the difference is? There's no traffic on these guys. So it's pretty incredible that the infrastructure that they built for us to get around town. Great place. We call it a golf mecca. There's golf courses everywhere and golf course communities. We have a lot of properties, rental properties in our golf course communities. This is the clubhouse at Avery Ranch, one of my favorite communities. There's the view from the clubhouse overlooking the lake in the 18th green. Just a great time to go out and have a day of golf. So if you do visit me here in Austin, let's get an excuse to go out and do some golfing, or maybe get on the lake or whatever. That's our pool complex at Avery Ranch, which our tenants get to have the benefit of using. And then, of course, this is Lake Travis, which is our lake. I live up on a hill. Probably could see my house on this picture if I had a zoom. And it's 75 miles long and 225 miles of shoreline. And so we just have a wonderful lifestyle. The water is still 82 degrees right now. So can you imagine that? The temperature outside is 85 and the water is 82. It's wonderful. And it's one of the cleanest lakes in Texas. Lakes run through Austin. Well, this is Lake Travis, one of the bigger ones, just 14 miles outside of Austin. And then we have Lake Austin, which runs through the more expensive part of the Austin area. And then we have Lady Bird Lake, which is the lake that you saw when I took the picture from the Hyatt, that famous picture of the skyline. There's a marina right there that's just across from Carlos and Charlie's. One of the great things about coming to Austin is the great Mexican food and barbecue that we have here. Everybody loves their Tex-Mex and their barbecue. So when you come out and visit us, let's hit the lake and then go find some barbecue. All right. So what we try to do is put together a millionaire real estate investor network. This is what I teach. Let me jump ahead here. That slide's out of place, so I'm going to come back to it, y'all. All right. All right. Typical single-family home that we're buying here. This is a 1,700 square foot house, and this is your typical home that you're going to probably get somewhere between $1,400 and $1,500 that you could purchase for $175,000. This is a home that you can purchase for about 125, 130,000, and you're probably going to be getting about $1,200-1,300 a month rent for that. Here's a typical 2,000 square foot. This happens to be in Avery Ranch. We're now getting between $1,600 and $1,700 for these homes. 2,000 square foot, only maybe 5 years old. Same model here, same type of thing. And I'm going to show you some pro formas on these so you can get an idea of what, and camp out a little bit on those so you can see what kind of cash flow you're going to end up getting. Here's a duplex. This is right down the street from my office here. We're not big on duplexes too much because duplexes were built in the early 80s, and they have a tendency to get beat up, and they also have a tendency to have been priced up by investors. We found that oftentimes you could buy two houses next to each other cheaper than buying one duplex of the same size. Here's a model sale leaseback that an investor bought from me a couple years ago, and the home builder is leasing this home back. And this is a 3,200 square foot. I actually have this one for sale right now. It is listed for $200, and I just lowered the price. It was $269, I think, for 3,200 square foot in a golf course community, and it's a really nice floor plan. And so that's about as big as we do on most rentals. But this isn't. We'll talk about one of the strategies that we use is buying a home now that you could eventually move into as a retirement home. In other words, if you ever thought about moving to Austin, you could buy a home now, get the tenants to pay it off over time, come in, after so many years, and then renovate it and move into it and have a free and clear house to live in that's been paid off by somebody else. All right, here's your typical pro forma with a 20% down payment. Now you can do 20%. You can even do 10% down on Fannie Mae foreclosures. A lot of people are using their self-directed IRAs to pay cash. We're seeing a lot of cash buyers out there right now, or they're just paying cash. We're seeing a lot of foreign money come in and people paying cash. So because they realize that real estate is basically a collection of commodities, and it's also got so many advantages to it. And there's a pent-up demand. People have been on the sidelines for a long time, and so. But here's your typical 20% down program. $130,000, $26,000 down. Some closing costs are about $30,000 to get in, and you have a loan amount of 104. 4.25 is about the current interest rate. Total payments about $832. So you add the management in there, and you're at $946. And so now you're looking at $1,275 to $1,375 rent, and that's going to give you a pretty good positive cash flow right from day one. So that's what we're doing out here. It's great to see positive cash flow. We had one lady whose total outgo was a little about $800 a month, and she just got a $1,325 rent. That's a good return on an investment. What you do is you take that positive cash flow and you pump. If you don't need the income, you put it back towards the note and accelerate the note payment off, so that's paid off quicker. Here's a $150,000 purchase with $30,000 down. Loan amount of $120,000. Total payments about $1,071, and just going to throw off between $350 and $350 and $450 in positive cash flow. You can adjust that up and down. We didn't put expenses in here for for your daily expenses and things like that for property management. Property management's in here, but we didn't have like vacancy and leasing fees. What I do is I have a pro forma, a real pro forma that I put together that I send out on each investment property that we've got the numbers plugged in. You can see exactly what your cash and cash return is, as well as the capitalization rate and things like that. But the bottom line is we're enjoying positive cash flow with minimum down. Same story here, $175,000 purchase. That's your typical 1,700 square foot house, and total payment about $1,227 with 20% down. Obviously, if you paid cash, you'd only be looking at about a $350 in your taxes, $60 for insurance, so that's $410, and then you would have management so you're about $538 with your taxes. And so that throw off about $1,000 a month positive cash flow if you paid cash for $175,000 purchase. So it'd give you about $12,000 at the end of the year plus your tax benefits. Now a $200,000 purchase These are like those homes that I showed you, the 2,000, 2,300 square foot houses in Avery Ranch, getting between 1,550 and believe it up as high as 1,800. We did see the highest rents we've ever seen in Austin, ran up over 1% of value. They come down a little bit because if summer is over, but still we're looking at a pretty good range, and we're still looking at a pretty good positive cash flow. And so this is a typical pro forma on 200,000, and enough to get the note paid off sooner by just throwing that positive cash flow toward the balance. All right, now this is stuff we skipped over last time, and I want to get back into it so you can kind of get some more ahas and some big whys. One of the things about real estate is you get to enjoy the leverage. We hadn't seen a whole lot of leverage appreciation recently, but now with the pent-up demand, according to Jim Gaines of the Texas A&M Research Center, he says we're expecting to see over the next few years about 5% appreciation. And we don't bank on, can't promise appreciation, but the historical charts show, and with the people moving here, I pretty much can say that's probably what's going to happen. So $200,000 property goes to 210, 210 goes to 222. Hopefully that continues to happen. But the nice thing is that when you only put 10 or 20 or 30% down, you get the benefit of leverage. You can avoid taxes through a stepped-up basis. And once again, I'm not a CPA or an accountant, so you really do want to talk to your accountants when it regards to when you're talking about anything having to do with tax advice. But I can tell you from what I know that if you pass away and let's say that home you bought investment properties and you may have built up quite a portfolio before you pass, if you then let your kids inherit the property, your kids will get a stepped up basis, which means that let's say you paid $100,000 for a property in 2012 and you pass in 2050 and that $100,000 property is now worth $1 million, then if you sold it the day before you died, you would pay a capital gains rate in today's dollars of 15% or more. And not talking about estate taxes, I'm just talking about capital gains. If you pass, your kids get what's called a stepped-up basis, so all those capital gains would have been wiped out. So check with the CPA and make sure that that's right and still in the code. You get to do a lot of write-offs. If you make it a business, some of the trips that you take can be included in the expenses on trips, going out and looking at property. It's an awesome ability to become financially free. All it takes is 10 properties paid off free and clear. It's gonna that's not unthinkable, and you can do it. And it's just something that could be, especially for those in high tech or have other retirements. This is a great way to augment. I just had a gentleman in my office that works for IBM. He's getting closer to his retirement. He's got a pretty good retirement portfolio already. And what he's decided to do is go into business with his younger children, who are in their 30s, and they're going to start buying up single-family homes and investment properties and make it a business. And because they have a passion for real estate, and they already have their, his 401k is full, and he's got plenty of stocks, and now he just really feels that he wants to diversify. So it's really good that the father gets to mentor and be involved with helping his kids start a real estate business, a real estate investing business. And I think it's great because you can start at any time. You can be 18 years old and buy a property. So we're encouraging our kids to, when they get of age, to start down that road and start buying property. One of the great things about real estate is you get this thing called depreciation. What it is it's passive paper write-off, and what it basically means is you can take the value of the building. Let's say the building is a $150,000 building. You can't depreciate the land that it's sitting on, so you take the building value, divide it by 27.5 years, and that's what the IRS allows you to deduct every year. Paper passive write-off. In other words, it's about $7,000 a year in write-off against income. And we'll explain that, though. There's, of course, your ordinary income, and then there's the income from the property itself or from other assets. But the nice thing about the passive write-off is, let's say you do get positive cash flow on the property, you can use the depreciation to cover that to write off over the top of that income, and it'll cause it to be a really kind of tax-free or tax-deferred income where you're not paying taxes today on it. Another neat thing is if you're making $100,000 a year or less, you can, well, let me get back to this. It's, okay, yeah, we're at the right point. If you make $100,000 a year or less, you can actually write off passively cover your ordinary income up to $25,000 from this passive paper write-off. In other words, let's say you had 3 or 4 rental properties and they were break even because you had a higher mortgage on it, but you had this $7,000 per property write-off. Let's say it was 3 properties. That's $21,000 that would be able to now also shelter your ordinary income. Once again, I'm not a CPA, so check with them on this. I'm throwing my disclaimers out because in real estate they always tell us, don't give tax advice. Well, check this tax advice out, and if I'm wrong, let me know. But what the bottom line is that that it can really save you a lot of money. That gets phased out for those that have incomes up to $150,000 or more. And what I mean by that is that if you make $150,000 or more, the government doesn't allow you to do this passive paper write-off to cover your ordinary income. And so what it does do is it does one of 2 things. It'll store up the depreciation on that particular property, gets stored up in the property over time. If you're not able to use it to shelter either the income from the property, or you'd be able to use it to pass on shelter other types of income that you get. It gets stored up in the property. In other words, year 1 you get $7,000 depreciation. Year 2 you're going to get another $7,000, but if you don't use it, it's now $14,000. Year 3 now you have $21,000. Year 4, this goes for 27.5 years. And the beauty of that is that when you take this into account for a retirement strategy, what you're seeing is that during your income produced, if you're making over $150,000 a year, you don't necessarily need to take these deductions now. What you do, because I mean it would be nice to, but if you can't, and I'm going to show you a way to do it. If you can't, then let it store up in the property. So let's say it's now 27.5 years later, and you had paid off this property, and now you're in your 65 or 70 years old, and you're ready for retirement, and you've got this loan that was on a 30-year mortgage that's paid off, because you paid it off quicker. Now this house is throwing off positive cash flow, and normally that would end up being income to you, obviously, because it's income. But don't forget, you'd let the property store up 27.5 years of depreciation because in your income earning years you were making too much to take it. Well, now that you're not making as much income, now that all of a sudden shelters every bit of that positive cash flow that you have on the property. So it only works for properties you hold and hold and hold, or tax defer exchange into more properties. If you ever cash out of a property, sell it for cash, then that whole scenario doesn't work. The depreciation goes away or is recaptured, and you don't get the benefit. So it's nice to know that you could build up a portfolio of properties that have all this great stored up depreciation. When they're paid off and you're no longer working so hard, you can now use that depreciation paper write-off to shelter your income in your retirement years. So there's another rule that you might want to check into, and this is what happens with me. I haven't paid taxes in a long time because I own too many rental properties, and all my income is sheltered because I'm a real estate professional, and that's there's certain IRS rules that allow those that are real estate professionals. There's a definition. It doesn't mean you have to have a real estate license. It just means you have to have a definition of what is a real estate professional, and it's very specific in the code. You have to, there's a lot of things. You have to be involved with real estate, and you have to be involved in leasing, and you have to be an active manager, and there's a whole list of things. And if you're interested, I can get you the IRS code for that. But what it does is allows you to, if you were a real estate professional, it allows you to use that passive income during your from the depreciation now instead of waiting for later. And so that's also a really exciting thing if you wanted to shelter your income. This is kind of what like a doctors do. They get their wife to become a real estate professional, not necessarily a license, but that's good too. That proves that you're more in the business. And they own rental property. All they have to do is, all the spouse has to do is work 750 hours a year. It's about 15 hours a week in real estate, these activities, and 50% of our business activities have to be in that real estate related field. In other words, she can't be working a 40 or 50 hour pharmacy job and claim to be a real estate professional. But it's great for those that have wives that are staying home, or even husbands that are staying home that are taking care of the kids or whatever, and get their 15 hours a week and prove that they're a real estate professional and can shelter the high income earners in income through depreciation. That's a mouthful. Revisit this. I think you'll find if you run it by your CPA, I'm talking the truth here, and I encourage you to do so. All right, another tax strategy is called the 1031 tax deferred exchange. This is how, if you have properties for the long haul, you've had properties, or it doesn't really have to be a long haul. It just means that if you've got a gain in a property, you've got your equity has gone up and your loan balance has gone down. If you wanted to buy more properties, you can do what's called a 1031 tax deferred exchange. 1031 refers to the IRS code. What this allows you to do is, let's say you had a house in California that you bought 30 years ago, and you maybe say you owe $200,000, and now it's worth $1 million because you've had it for so long. And now, if you sold it, you would end up, depending on how your gain works out, you might end up with a whatever you paid for it plus whatever your gain was. It could be $500,000, $600,000, $700,000 gain, and you'd pay long-term capital gains 15% right now. So that's a pretty good chunk of change. And so what happens is the IRS allows you to defer that into other properties, defer that taxable gain in other properties. So you can go out, let's say take that same $200,000 owed property that you owe $1 million, that's worth $1 million. You can go buy 10 single-family homes in Austin, Texas for $100,000 a piece, or you could buy 3, whatever it is, wherever you want to buy, you can buy more properties with it, and it allows you to roll over your taxable gain into those properties. And that goes as long as you keep doing this, and as long as you don't cash out along the way, then you will also fall within that stepped-up basis. So we've seen many people start off with one house and then turn it into a couple fourplexes, and then turn the fourplexes into an apartment complex, all through the use of the exchange. Then the apartment complex, and get another bigger apartment complex through the exchange, and now they've got this huge asset that if they sell, they're going to pay capital gains and depreciation recapture. But if they pass away and pass it to their kids, they'll get the stepped-up basis. Once again, check with your CPA. This is another cool thing. To have the past 5-year exemption, that's, that most people know that as long as you've stayed in your property for the last 2 out of the past 5 years in your primary residence, that you can defer any capital gains on that property, or not defer, but have a tax-free gain. So what this means is that you I don't see a lot of people worrying about their gain right now. It seems like real estate primary residences have had their tough times in the past 5 years. But what it does mean that you could go buy an investment property, let's say a really nice home out here on the lake for $500,000 or $600,000, or Lake View property for $500,000 or $600,000, as a potential of turning into your primary residence sometime down the line. Well, you could use your exchange to get into that, by exchanging rental property to get into it, or you could just buy it as an investment property, and you could eventually then move into that property, and the gain that would have been gained on it, because our prices are competitive right now and going up, any gain that you would have on that would be covered, as long as you were there for 2 years, would be covered under the exemption. So that's a great way to get into a really nice property here and be able to take advantage of the 2 out of 5 year rule. Of course, it's $250,000 in gain, or $500,000. That's for a single person. $500,000 exemption for a married person. This is where some people would take their investment property, and they would buy. Let's say they have a really good investment property they have somewhere, and they want to now buy this really nice lake house, like I say, a lake mansion, and they could turn that investment property, buy the property as an investment, rent it out for a year or 2, then move into it. That way, the gain that they would have had on the investment property, if they ever sold it, can be covered up to $500,000 by this exemption. Hope that makes sense. So buy your retirement home now and move into it later. The other way to do that is we teach the younger kids, people who are just getting out of college, to build up a real estate portfolio by becoming real estate gypsies. What that means is they can move into their first owner-occupied house, live there for a year or so, then rent that out and then go and buy another rental property, live in that for a while, and then they're buying it with low interest rates and low down, then go buy another investment property, and so in 3 years, and actually in 2 years, you could have 3 rental properties, all with owner-occupied financing. Just because you really need to be in the house for a year. Year 1, you could move out to the next property, and then year 2, at the end of year 2, you could buy that 3rd property owner-occupied, and now you got 3 properties owner-occupied. So it's pretty cool. Okay, self-directed IRAs. I know people were looking at this to understand what people were doing. People, most of the people have got their, most of my clients have got their self-directed IRAs in stocks and bonds and other types of typical traded type of investment vehicles. But did you know that you can also buy real estate in a self-directed IRA? It's a good way for you to diversify your investments. You can do it with purchasing real estate, and it's a lot easier if you purchase your property through your self-directed IRA as cash. Excuse me. When you buy it with a loan on it, there's more things that you need to know about. It still can be done and is done all the time, but you need to know what the ramifications. So let's say you put 50% down and you borrow 50%. We just have to walk you through that. A lot of people are just using it to pay for cash and getting that nice positive cash flow from day one. What's neat about is if you've got the capital gains and the rental income that you get from the property is all tax deferred into the IRA. So you don't ever take the money from the IRA at all. The money goes and the IRA buys the property through its custodian, buys a property, and then all the rent goes back into the IRA. So all the positive cash flow goes back in there. And then if you sell it for a gain down the line, that property also goes into the self-directed IRA, and that is tax deferred just like any other type of gain that you would have on an IRA. Once again, I'm not a tax guy nor a financial planner, so make sure you check with them before you do anything. All I'm doing is showing you some different strategies that you might want to explore. Could be a great retirement strategy because if you're in a lower tax bracket at retirement, you'll be paying when you start paying income tax on the disbursements. You're going to be paying it back at your new lower rate rather than the rate that you may have if you have high income now. Some caveats here: you must hire a trustee or custodian to hold that IRA and the IRA assets and to administer the account. So it's not just your typical Schwab or whatever, you have to find a IRA custodian that's what they do. And there's several of them out there that are legitimate and have been around for a while. And if they're needing recommendations, just call me and I'll let you know. But there are specific companies that do just or know how to do the real estate IRAs. It's not just your typical Schwab kind of thing. Got to follow the IRS rules, and that's why you also want to have some consultation with people who know what they're doing and attorneys that know what they're doing when it comes to the IRA rules. You can't self-deal, and there's specific rules. In other words, you can't buy a vacation property and then live in it 2 weeks out of the year when you're using it from an IRA. You can't even personally work on the property. You can't go fix it up. It's all got to be handled by a management company. It's got to be so. There's some rules there that you need to know so to keep you out of hot water and not disallow your IRA. So it is about bottom line is consult with the experts, and that's what I help you do. But I think it's a great way. We've seen a lot of people. Even my property manager has bought, and he just bought a paid free and clear for a house. It's $130,000, $125,000, and he's getting $1,300 a month rent on that, and he's enjoying the positive cash flow. And he could even, I don't think he bought it in his IRA, but he could have. So all that income would go back into the IRA, and he got it at a good deal. So when he sells it later, if he wanted to, he wouldn't pay capital gain on it because it goes back into the IRA. Kind of nice. Okay, so my target markets to help you out, just so you know what I've been an expert at, is popular homes in popular areas, places where people want to live. I don't sell homes where people don't want to live. In other words, there's a lot of investment networks that came out to Austin and bought houses in areas that out on the prairie where nobody wants to live. And they bought them just because they could, and that's not what I'm looking for. I'm looking for a long-term investment and, more importantly, a long-term relationship with my clients. And I do have a lot of great long-term relationships with my clients that go back many years, and so they're now coming back in and buying more. It's been kind of a slow time for people to decide, well, should I get back in the investment game? They go, yeah, I really enjoy my Austin investment. I think I'm going to come back in and buy some more. We're also doing a lot of work with distressed properties, pre-foreclosures, foreclosures, REOs, short sales. We just made an offer on a property, a real nice property built in 2007. It's about 1,650 square feet, and it was listed for $139,900, and we have offered $116,000 for the property. So that's a pretty good difference in value there, and I think Fannie Mae's, we're going to get real close to getting that property for that price. It's a Fannie Mae foreclosure, and once again, with Fannie Mae foreclosures, you can buy them with as little as 10% down. You can search for distressed properties in Austin on my site called austinreos.com. REO stands for real estate owned. REOs is when it's a bank-owned property, it's considered an REO. We also do work on short sales, but short sales are kind of tough to administer because you never know. What we do is we put our offers in on short sales and then move on to the next property, because short sales are notorious for having for not only delays but also being underpriced, and then the bank says, well, we're not going to take that price even though the owners accepted the price. The bank can always come back and say, well, we've done our appraisal on it and we want more. So it can be frustrating. They're getting better, and we don't ignore short sales. We're just saying that you have to know how to play the game, and we know how to play the game. I like, personally, bank-owned properties or Fannie Mae-owned properties because you actually have a department you can work with that will respond and get you answers and negotiate with you rather than just letting the file sit on the table for months and months. Model sale leasebacks, those are great if you can find them. Some of the builders are still now, when they build a model home, they'll lease it back. We always like those. And I get calls from builders from time to time that say, hey, I heard you're the investor guy. Do you want to do a model sale leaseback? And they can be good deals, but there's a strategy that I could spend 20 minutes on just for that. And then pre-leased homes. And what that means is that, I have a certain amount. I sold 500 properties in the last 6 years, and a lot of those majority to investors. Those investors, for whatever reason, are maybe needing to sell. They are going through a marriage, divorce. They're paying for college education, whatever it is, and they want to sell. And they've got these properties. They've got a tenant in place. They're managed. They're ready to go. And I've got about a dozen of those right now. And the great thing about that is you have no turnover as far as, you already have a tenant in place. You don't have to pay for the leasing fee to get the tenant in. There's no vacancy downtime. You get the rent, though your payment doesn't start until 2 months after you purchase the property. You get the full rent and then the next month's rent. You get the deposit. And so it's a really nice way to be able to just walk into a property, especially for investors that are new to the business, and they're like, well, I'm kind of scared of having a vacancy. I'm kind of scared. Right now our vacancy times are 10 to 20 days. It's a very tight market in Austin right now for rentals, but still, to have one that's already got a tenant in place is a great deal. So if you're interested in those, you've got all my contact information is at the bottom of this slide, and I will also be sending you a copy of the YouTube video of this so you can review it when you have time and when you want to get a chance to come on out here and take a look. Okay, your pro team. The people on the left here are people that I help you arrange. You don't have to use them, but they're proven. They are a proven team. Is myself, be a real estate broker. We have great lenders, 2 or 3 that we use most often. One of them, our sponsor for the seminar out in California, is Prime Lending, and they're one of the few investors that will go up to 10 properties. So if you the loan up to 10 properties. So if you have more than the 4 property limit that Fannie Mae, that most banks have. Fannie Mae, Freddie Mac actually goes to 10 properties, but there's only a few lenders that actually lend to 10 properties. It's a great way for, number one, maybe you can refi. If you have over 6 or 7 properties, you know how difficult it is to get more financing. But now with Prime Lending, you can go up to 10, or you could pull some cash out if you have equity in your other rental properties. Get the interest rate down, pull some cash out, or just get the interest rate down with these low rates, about 4.25 right now APR, that on investment property, and that will give you a really good way to get to restructure maybe your financing right now and get everything on a good fixed rate. I know a lot of my clients that bought several years ago were on these hybrid ARMs, like 5-year fixed, then goes to an ARM. ARMs are actually not too bad right now because the rates are so low, but in the long term, obviously inflation has been told by everybody it's coming back, so that means rates will probably go up. So maybe a good time to fix them. The property manager and the leasing agent, same company. I use Austin Landmark Property Services, and they're also one of my sponsors. You can use whoever you want, but it's best to use somebody that's proven track record that's been around for a while. The people on the right are people that you need to put together as part of your financial team. Your CPA, your financial planner, your lawyer, your asset protection company, your self-directed IRA custodian if you're going to go down the self-directed IRA route. But they definitely need to be, those are people that you will need to engage with to get your private counsel with them. I work in conjunction with them, but I don't give those types of advice, that type of advice. Our property manager here is our sponsor, Austin Landmark Property Services, and their duties are to lease the property, manage the property, collect the rents, take care of any maintenance issues, send you the difference of the check of from the rent, whatever's left over after any maintenance and management, and then take care of anything. You don't have to do anything. You're never going to be in contact with a tenant, never going to get a call in the middle of the night for a broken toilet. So, and I use the company that I've been using for a long time, who manages over 200 of my clients' accounts, and that's Rick and Mike Ebert of Austin Landmark Property Services. They've been around since 1986. And it's all they do, which I like. I like a management company that just does management. I don't like them doing insurance and real estate sales and all that other kind of stuff. That's what they focus on. Our other sponsor, once again, is Prime Lending. Goes up to 10 properties. The rates in the low 4s. And we have 15% down on 30 or even as low as 10-year amortization, 10% down for Fannie Mae Home Path, which is Fannie Mae foreclosures, and that's pretty cool to be able to. Like I said, if you bought that property that we're working on that was offered at $139 by Fannie Mae, and you pick it up for $120, and you put 10% down, you're looking at maybe down in the low hundreds what you owe on it, and your positive cash flow with 10% down. That's great. Then take that positive cash flow, plow it towards the note. You'll have that the home paid off for in 15, 18 years, and with only a 10% down investment. Pretty cool. You can also pull cash out if you have properties, and Prime Lending is licensed in all 50 states. So if you have investment properties or even your own properties that you want to pull some cash out, you can do that here with Prime. My job is to be your eyes and ears. I'm looking for those long-term relationships. I represent you and not the seller. I help you search for and find awesome properties. I act as your eyes and ears, and we do a lot of video. We're the video kings out here. I'm actually a video coach for real estate agents. We show them how we do a lot of video to show you the properties through and give you hands-on through video the lay of the land and the property, and you can do everything but smell it with the video. So that's why we go ahead and when we find a good property, as we did with this home. In the home that I was talking about, the Fannie Mae foreclosure, the gentleman that bought it is in Corpus Christi, which is about 4 hours away from here. So rather than him coming all the way up here to look at this property, we went down and took a comprehensive video of the property and the neighborhood and everything about the property, from the hot water heater all the way to the schools and everything. So you get a real good feel for what it was. He made an offer, and he won't come up and take a look at the property until after it's already been under contract. And of course, you have an opportunity to leave, to get out of the contract if you don't like what you see. So, and I help you from beginning to end, and even all the time when the time is for you to get out of the property sometime down the line, to sell it for hopefully a nice gain, and I'll be there for you at that time. So the plan of action for you that I've done hundreds of times with my clients is to contact me. We'll discuss your plans and strategies, and then we'll make an application with the lender if you're going to borrow. If not, then we'll make sure you're set up with a proper custodian for your self-directed IRA. and then we'll move forward with the next step, which is you can make plans to visit Texas for a tour. I encourage that, and we'll take you on a nice tour of the Austin area as well as look at specific properties. And then you may or may not find the property that you want while you're here. Typical example is they'll have my clients fly in on a JetBlue on Friday. They'll stay here Saturday and then Sunday, and then maybe fly back Sunday or Monday morning, and that way they've got enough time to get the lay of the land. And it's about 50–60% of the time they'll buy one while they're my clients will buy one while they're here, because they're here to buy a good property, and we show them the good ones. Or they may go back and they already know the lay of the land, and we'll send them a property over the next few weeks, and they say, well, this one looks good. So we do a lot, once again, with video. And what your strategy is, you can make an offer on a property sight unseen or seen with my video, and then you have a 10-day or 15-day option period. You can fly out and inspect the property and have the inspection done with the state licensed inspector and all that fun stuff while it's still in its option period. So you've got an option period to be able to back out, and that's another way strategy. What we do is that you put it under contract, then fly out, take a look at it, say yes or no. If it's no, you just you get your earnest money back and move on. If it's yes, then we move forward with closing. So hope this has been educational. I know it's been a fire hose of information, but the best compliment I can have as a professional is a referral from you, a satisfied client, or somebody that you may know. If you're not a satisfied client yet, but I do love your referrals, and I do appreciate the business. If you know anybody that wants to invest in real estate in the Austin, Texas area, or really anywhere, join us. And also, or send them my way. Also, don't forget the October 24th, 25th presentation in Irvine. If you're not in Irvine, that's okay. By the way, for this is going to go on YouTube, so this is year 2012. So if you don't go to the Hyatt in 2013 or 14, I don't know. I'm probably not going to be there on the 24th and 25th of those years. It's kind of fun. So yeah, on Wednesday the 24th, I'm going to do Investor Crash Course, which is similar to what I did here, but more in depth. And then Thursday the 25th, I'll be talking about Austin specifically. And then we'll also be introducing reinvestorclub.com, which is a free investor club that I'm beginning. That is first networking with serious investors, and also presenting properties and further education similar to this that I'll be putting on from over the course of time. All right, as we sail off into the sunset, I appreciate your time here, and I hope that we can engage. My number is 512-423-5626. Call or text. Once again, Kenn Renner, 512-423-5626. And my email is Kenn, Kenn, at buyaustin.com, buyaustin.com. All right, I hope you had a good time, and let's connect, and I'll see you at the top.